Hi, I'm Jimmy. In this video, we're looking at how we should value a stock. Now, there are many different ways to try to come up with the intrinsic value, also known as the fair value, for a stock. Our goal with this video is to try to go through some of the top valuation methods that are out there and then see if we can come up with which types are best for different types of stocks or different types of industries. Now, I'm not going to spend too much time on how to do each calculation of each valuation method. I've done some videos on some of them so far, and I'll be sure to get to the others ASAP. So I'll leave a link in the description below for some of the different valuation methods that we go over in this video. This video, I'm really trying to focus on how to apply them or which companies are best to apply them to. Okay, so let's jump right in. So we can break valuation methods into three primary groups. First, present value models, then asset-based models, and then finally using multiples. Many times we can use more than one valuation method to sort of double check ourselves. And often this is a smart thing to do. Okay, first up we have present value models. Now the question for us to consider here is what cash flows are we using to try to come up with our fair value? And this brings us to our next level of valuation models. And this is where we get to a few more answers behind valuation methods. So first we have discounted cash flow. Now this should actually say discounted free cash flow. And the concept here is that free cash flow is what's available to the company after they cover capital expenditures, but what's available to the company to grow the business or maybe pay out as dividends or pay off debts or whatever they elect to do with it. So if we wanted to take the approach of being a business owner, if we were looking to acquire an entire business, sort of like Warren Buffett does, sort of like he has since he started investing, well, this is one of the best methods to use. And personally, this is my favorite one. And this valuation method works great with companies that sort of blue chip like companies. Think companies like Coke, Walmart, or McDonald's. Now, on the flip side of that, I might hesitate in using this method with a lot of financial companies. Things like insurance companies or banks or even investment banks like JP Morgan. They may not work quite as well. It really depends on the structure of the company, but I would hesitate with financial companies. There's other methods that are a bit better off since financial companies, their free cash flow can be a bit skewed compared to most typical operating companies. Okay, simple enough. Now, if the stock we're analyzing pays a lot of consistent dividends, and this really works best if those dividends are mostly tied to the profit of the company. So if they pay out a large percent of their profits or something like that, well, discounting dividends is something that is known to work quite well. They call that the dividend discount model, and that could make a lot of sense with those type of companies. Now, with the dividend discount model, in order for this to be the best method for us to use, dividends should be the primary source of shareholder wealth in that particular investment. As an example, if the stock doesn't move much, but it consistently pays out a good dividend, well, that could be a good one to consider using this method on. Because with DCF, discounted cash flow, well, that's the cash available to the company. With the dividend valuation, well, that's what's actually being paid out to investors. So it's a same concept, but a slightly different approach. So we might consider using this for something like a real estate investment trust or even a high yielding ETF. They could both be good candidates for the dividend discount model. Now, I've done videos on both of these methods in the past, so if you're curious, I'll leave links to those below as to how to do the actual calculation. And the advantage of both of these methods is that they are very fundamentally sound methods, and they're popular ways of calculating the fair value or the intrinsic value of a stock by both professional investors and analysts. The disadvantage to these methods is that in both scenarios, we are estimating future free cash flow or future cash flow in the case of dividends. Either way, the results of the inputs the model is very reliant on the inputs. So, you have to be fairly comfortable with making those estimates. But still, these are some of the top methods. Okay, simple enough. Now we move on to our asset-based valuation. So the theory here is that the fair value of any company is simply the value of the company's assets minus the value of the company's liabilities. So assets minus liabilities. Now, this is not as simple as taking the book value of the company which is on the balance sheet, and it's calculated in a very similar way because in that they're using, let's say, the depreciated value of an asset, and that might not really be the fair value of the actual asset. So they're not really comparable. It's not the same thing, although conceptually it's similar. Now, this valuation method can often be looked at by analysts or professional investors as a sort of floor value of the company. A good example is, imagine a company had no operations, but they had $100 in cash. Well, they have no liability, so they don't owe any money. What's the company worth? We could say they're worth at least $100. Maybe they have a great idea that it would make them worth more than that, but baseline, they're worth $100. If they had $50 in liability, so they owe 50 and they have 100 in cash, well, they're probably worth 50, since in theory they would pay off the other 50. Again, they could be worth more, but the baseline would be that. This valuation method works well for companies that are close to liquidation, or even if a company consists of primarily tangible assets that have a market-ready price. Those would work very well for this type of method. Good example would be companies that drill for oil. An oil company, hypothetically, they've done surveys, they have an idea of how much oil is in the ground. They publish that information. Well, we could very quickly find out the price of oil. So we do a very simple calculation. How much oil do they have access to? How much is oil right now? And you could come up with a rough estimate of what the value of that asset would be. Subtract what they owe. There you go. On the liquidation side of the possibility with this particular method is, let's take a company like Macy's. It may not be a perfect liquidation example since they're not really liquidating, but they've had a lot of troubles since they've had trouble adopting to the internet age of selling. And because of that, profits have struggled and frankly threatened the sustainability of their business. But they do own a ton of real estate. So if there was a way for us to estimate the fair value of the real estate, not what they're carrying on their books, but the actual fair value, if they were going to sell that real estate, what would happen? Well, then we would consider whatever cash they had, we would deduct any debts that they have, and just like that, we could say, well, that's sort of the baseline value. That's the floor value for this particular business. That's where this type of method really comes in handy. Now, one disadvantage of using this method is that coming up with the fair value of, let's say, Macy's real estate, that's not that easy. Liabilities are a little bit easier. Usually you could take those off the balance sheet, but assets can be very tricky. The advantage is that in theory, if you did come up with those values, those should be a very reliable value. In theory, you could, if it was undervalued using that method, many big hedge funds would go out of their way to do everything they can to buy it, break it up, and sell it. Okay, simple enough. Now we're shifting down to multiples-based valuation methods. Now, these are some of the most popular ways to value companies. So, we're going to break this group into two primary groups. The first group is companies that if we wanted to use enterprise value as one of the key components of our valuation. The second is when we use the company's current stock price. Now, the guiding principle of both of these valuation methods is known as the law of one price. The law of one price tells us that two identical assets should have identical prices. This is logical. This makes a lot of sense. So in our case of valuing stocks, well, in theory, two similar companies should have similar multiples. Once again, this is logical and makes sense. So on the enterprise value side of this, we're considering something like enterprise value to EBITDA, which is short for earnings before interest, taxes, depreciation, and amortization. Okay? Or we might use enterprise value to sales. Now I'm going to make a video on how to calculate enterprise value, and I sort of touched on it in my enterprise value to EBITDA video. And in that video, I used an example of Tesla as our sort of working example. And Tesla is a good example to use for this type of valuation method because this valuation method tends to work with companies that aren't profitable. And that's true because companies tend to have a positive EBITDA. You could also use enterprise value to sales, same general concept. If they don't have positive EBITDA, but they have obviously positive sales, well, that could be a good method to use. Okay, now the stock price multiples, well, these are the super popular ones. These are things like price to earnings, or price to sales, or maybe price to book value, or even price to free cash flow. Each of these calculations can be very effective at coming up be very effective at coming up with a fair value and even screening for or identifying undervalued or overvalued stocks. This is one of the primary advantages of this method is it's very simple to do. It can be done very quickly. We can use price to earnings for nearly any type of company. It works nearly everywhere. It's probably why we hear it quoted so often in financial news or articles or whatever it is. This is one of the simplest ones to apply broadly as long as the company is profitable. Price to sales works in some situations, although in my mind it really makes sense as a way to analyze a company that isn't profitable. Perhaps you pair it off with enterprise value to EBITDA. If you paired those two together, you could have a way of double checking yourself. And to me, that's where I would use price to sales. Price to book value, well, this actually works much better with financial companies. So where we said discounted cash flow wasn't the best one to use with them, price to book value tends to work fairly well. Think insurance companies. Think a company like Berkshire Hathaway would be a good example of a place I would start with that. Now, price to free cash flow is likely to be a good complementary method to using discounted free cash flow. You're probably not going to come up with the same fair value with any of these. Every time you ever do two different methods, you don't have to come up with the same valuation at the end of the day. The goal is to get more information and see where things average out. Now, we may even come across some companies that we want to use different valuation methods on to see if we can come up with our best version of our intrinsic value calculation. Because perhaps they have a financial division within their business. So maybe with that division, assuming of course we have the data from the company, but maybe that division we use price to book value. And then we value maybe the more sales-oriented version of their business with discounted free cash flow. We add the two up, and I would say we're getting fairly close to a good estimation of fair value versus doing one method for the whole business. The key here is that we know the company that we're valuing very well. And then we could just follow Buffett's advice and stick with companies that we understand. He calls it staying within our circle of competence. But also, we need to be able to do the research to understand the business well enough that we say, oh, okay, I know what this division does, or I know what this company does. Here's how I'm going to value it. And if we do that, then following the general guide of these type of valuation methods should serve us quite well. And if you're not sure how to do that research to fully understand the company or where to start or things along those lines, well, I actually did a video on that exact topic. If you're curious, perhaps that could be a good next video for you to watch. I've got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.